Welcome back, everybody. Jay Martin here, CEO of Cambridge House. And I am very honored to introduce my next guest, Dr. Lacy Hunt, an internationally acclaimed economist. He's the executive vice president of Hoisington Investment Management, a firm that manages over $5 billion for pension funds, endowments, insurance companies, and many others. He's a best-selling author. He is regularly published in publications such as the Wall Street Journal and the New York Times, and he is one of the most respected economists of his time. So this was a real pleasure. Now, what I spent close to 45 minutes talking to Dr. Hunt about was, over the course of his career, how has he determined what information to pay attention to and what to dismiss? And most importantly, today, what is distracting investors from the core signals they should be focusing on to navigate some very, very complicated waters. This was an incredibly interesting conversation. I really hope that you enjoy it as much as I did. Now, as always, if you do, right beneath this video is a pinned comment where you can subscribe to my weekly newsletter where I debrief conversations just like this and plenty others. I share my key takeaways, anything that was shared off camera, and of course, I always talk about where I'm putting my capital as a consequence of these discussions that I have here on the channel. So that pinned comment is right beneath this video, and it's a free newsletter I publish every week. I love writing it, so I'd love to have you join the tribe. Okay, now, Dr. Lacy Hunt, I really hope you enjoy this.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Dr. Lacy Hunt, Chief Economist at Hoisington Investment Management. Dr. Hunt, how are you?
Very well, thank you.
So thanks so much for making the time to get in front of my audience and spend some time with me today. I really appreciate it. I thought an interesting place to start today would be, you know what, a lot of the guests that I have on my show and a lot of the guests that I see on my peers' shows are calling for runaway inflation. And it's really easy as a consumer to understand why that would be, because when a consumer good increases in price, we feel that immediately in our wallet. But obviously that doesn't translate into runaway inflation. I know you're one of the more outspoken voices opposed to that. So I'd love you to share some light on what you're seeing and why that idea is wrong.
Well, there's no question that we currently have inflation. That's really indisputable. The issue is whether these forces are going to be sustained. And it's our strong opinion that we're in the vicinity of the peak growth in inflation for the year. And that the growth and inflation that we're seeing right now will be the highest for a long time to come. This is the best that we get right now. The pattern will change very significantly as we go forward. By the end of the year, before the end of the year, I think it should be readily apparent that the level of economic activity is going to be considerably below where the pre-pandemic trend that was in place as we entered 2020 would have taken us. And I think that the price pressures that we've seen today are basically due to supply side disruptions, which are transitory. They do not persist. They can be vicious, as these are, but they do not persist. And in addition to that, the benefit from huge debt-financed fiscal packages do provide a transitory benefit to the economy. And so what happened was the supply curve shifted inward, and the demand curve shifted outward. So it gives you higher prices and somewhat better growth. But the move in inflation was quite significant. But that will change. The pandemic greatly disrupted production processes in the United States worldwide. And as a result, the flow of goods into the United States was tremendously disrupted. And this afforded the relatively higher cost producers in the United States an opportunity to grab market share. And they were able to grab market share by raising prices at the same time. There's a lack of competition. But as the pandemic problems abate and we begin to get a greater flow of goods into the United States, the picture will change, because the low-cost producers in Asia who have lost market share are going to want to regain market share. And the high-cost producers in the United States who've been benefited are going to want to hold. And that suggests we're going to see price wars. And the picture will change. The pandemic did far more to boost domestic output than the Trump tariffs of a few years ago. It was universally helpful to domestic producers in many, many different industries. And so that picture will definitely change as we go forward. And the other thing that will be happening on the supply side, it's really the supply, the adverse supply situation has actually raised ordering and demand by more than the fundamentals warrant, because people are frustrated. They cannot get needed product.
Mm-hmm.
So what do? They place a second order or a third order. And as these disallocations and bottlenecks and shortages come to an end, folks will start canceling the superfluous orders. And that will be occurring at about the same time that the transitory benefit from the huge sum of borrowed funds begins to lose its potency. There's probably more than 30 cases of debt financed fiscal operations in Japan. Give you a book up. That's it. There's 20 cases in Europe, maybe 25. Take the Trump tax cuts of 2018, debt financed. Second quarter of 2018, no question about it, great quarter, right? But what happened in the third quarter? It was okay, but the growth started decelerating. And then all the way through 29, growth was irregularly getting weaker and weaker, even though the Fed was constantly cutting rates.
Mm-hmm.
And the pattern of the economy going into 2020 was quite poor. In fact, in 2019, the world experienced the first contraction in global trade for a non-recessionary year. And so these packages, although they're huge, they don't last in terms of their benefit. But what does last is the debt. And the debt's a problem. The debt triggers the law of diminishing returns. If you increase a factor of production, such as debt capital, initially output rises. Continue overusing it, output flattens out. You still overuse it, output declines. And it's really difficult for a lot of practical people to come to grips with the fact that this is a nonlinear relationship.
Right.
People assume that economics is accounting, it's business. Well, no, it's not. if I told you I were a physicist and you had to be prepared to grapple with nonlinearities, you might say, oh, well, I don't like it, but I can understand. Or if I were an engineer or an architect. And so the excessive use of debt triggers diminishing returns. And so you get weaker and weaker. And you perpetuate the problems. You get a short-term benefit, and then the benefit flows away. And it flows away very quickly. And that's basically where we are.
Okay. Now, a couple things that you said there, Dr. Hunt. I have a lot of guests coming on the show calling for, I call it a vaccine-led recovery, however you want to word it, and us to come out of this with a lot of pent-up demand for services, I suppose, more than goods. But, what you said was you're expecting a reduction in economic activity compared to pre-COVID levels. And
I said the level of economic activity at the end of the year will be well below the trend rate of growth that would have persisted.
Okay.
That's the critical element. So you had a very weak trend rate.
Yes.
Coming back up. But when we start slowing down, it'll be apparent that the year-end levels in economic activity are going to be far below trend.
Okay. Thank you for clarifying that. Now, so a question for you about retraction.
Let's talk about pent-up demand. Talk about pent-up demand, because you normally have pent-up demand in a recession. The last year, when everybody was confined, couldn't travel, a lot of service sector expenditures collapsed. Travel and leisure, even doctor visits, took a big hit. People didn't want to go out, put themselves at risk. But what we had also happen last year was a huge surge in the demand for household durable goods.
Yeah.
Well, now the household sector is stock full of durable goods. They have home entertainment networks. They bought additional up-to-date computer equipment. They bought entertainment sets. They've modified their houses. They've expanded their houses. And so now what will happen is we will see a shift to entertainment and leisure, but the spending for durable goods is going to come off very dramatically. They're going to balance. It's going to be the reverse of last year. And the demand is not really recapturable. I mean, let's say you were planning to take 2 vacations last year.
Mm-hmm.
Well, if you have only time for 2 vacations, you don't really take a third, do you?
Yeah. No.
Maybe you work in a 2.5 or something. But at the same time, you're going to be shifting away from all of those goods that you acquire. And so the pent-up demand. The other critical factor that people need to keep focused with is the fallacy of the broken glass.
What is that?
Well, I suggest people look it up. If they don't know it, I'll be glad to explain it. But when you have a recession or a pandemic, some sort of economic crisis, a lot of businesses are failed. Drive around any community. See a lot of restaurants closed down, right?
Lots.
Other businesses. Okay. So when a recovery commences, we pick up the gain in spending from the firms that survive.
Okay.
But we don't capture the losses of those who failed. And so you may go into restaurants and you see them full, or other types of establishments. But you have to remember that they're full because their competitors went away. It's known as survivorship bias also. And so in early stage expansions, there's a divergence between gains and broad measures of economic performance like GDP and inflation and interest rates. You can have transitory divergences, as we have in the current situation. But one of the major problems is the fallacy of the broken window, broken glass. And that's what's going to happen here. It's nothing new. The concept came from a French economist by the name of Frederic Bastiat. Well worth looking up.
Interesting. Yeah. And I love the, as you said, survivorship bias. Did I catch that correctly? That makes absolute sense.
That's correct. That's what the statisticians call it.
Yeah. Okay.
And then also, GDP picks up current spending. It doesn't capture the losses.
Right.
So there is a major divergence there.
Interesting. Okay. Now,
by the way, I could make one other point.
Please.
If you look at the cycle dating work, which has been done for a long time, the original work was done by Wesley Clare Mitchell and Arthur Burns. People remember Burns' name a little bit because he was chairman of the Federal Reserve Board. In fact, he was chairman when I was in the Fed. So was William Martin. And in their very early work, they categorized inflation and interest rates as lagging economic indicators. In other words, when you come out of a recession, the GDP turns up, but inflation and interest rates still move lower. And you may say, well, that's a statistical. We haven't had a pandemic for 100 years. This makes it different. Well, there's a reason why inflation and interest rates have to decline after deep economic contractions. And here's the reason. If you start a recovery and inflation immediately kicks up, as it is right now, and it sustains itself, then what will happen is that the recovery will lose its legs. Because in inflations, prices rise faster than wages.
Right.
When prices rise faster than wages, what happens to real spendable funds? Goes down. What's happening right now? Which is rising faster, prices or wages?
Yeah, prices.
Prices by a long shot. In addition, if you get an acceleration in inflation, in a normal setting, people will import more foreign goods because they're cheaper. Now, right now, it's difficult to import more foreign goods because the West Coast ports are blocked, and we have a whole host of impediments, bottlenecks, and so forth. In addition, if you try to come up and inflation goes up immediately, then via the Fisher equation, the interest rates rise, and your interest rate sectors are depressed. So the reason that inflation and interest rates are a lagging indicator is not just a statistical finding of business cycle dating experts. It's a causal reason why inflation and interest rates have to lag. In fact, they're very long lags. From the start of a recovery, the start of a recession, to the low point in inflation, the lag is almost 6 years. It's a long time. And there are shorter cases, but even in those cases, the inflation rate remains low, even if it comes off the bottom. Inflation is a long lagging indicator. So are interest rates too.
That makes sense. Do any leading indicators come to mind, Dr. Hunt, that you pay the most attention to?
Say that again.
Are there any leading indicators that you put the most weight on?
Well, one of the reasons why inflation is a lagging indicator is because of the cyclical role of productivity, of output per worker hour. And so after recessions, you get a cyclical rebound in productivity.
Right.
There's a corollary to that. After deep recessions, and keep in mind, last year's recession was the deepest since the end of the demobilization at the end of World War II. There is a very strong rebound in productivity. The gain in output this year may be the highest since the late 1950s. But if you look at the three deepest recessions since 1948, they were 48, 1982, and 2009. And in those three cases, the rebound in productivity was almost 5% per annum. 5% per annum. All right, already productivity is gaining 4% per annum. Okay. And a number of those quarters are still in the pandemic. Okay.
Yeah. Right.
All right. Well, what's happening to wages right now? People are saying wages are going up, and they may be, but right now wages are up only 3%. Well, productivity is increasing 4%, but we have a reason to believe it's going to increase 5%. Well, if that's the case, what happens to unit labor costs? They're ultimately going down. And so once these abnormal conditions normalize, the ability of firms to cut prices is going to be there. And when the foreign goods start coming in, the necessity to cut prices will be there. There's another element that's happened. They say that invention is the mother of necessity. And so if you look at what happens to technology during crisis situation, wars, severe economic downturns, technology gets moved forward. In other words, things that might not have been implemented for 2, 3, 4, 5 years are pulled forward.
Yeah.
And think of all the things that have been done already. In other words, so not only do you have a cyclical rebound in productivity coming, but you've speeded forward in time the utilization of new technologies. We're not going to do the same things we did. And it's not going to be as costly.
Mm-hmm.
And there's not going to be as much business travel. Business travel will rebound. But it's not going to be as extensive as it was before. Because of the very reason you and I are talking to each other.
Agreed.
And so these factors will begin to play. And the pattern will change. And it will start changing just as the short-term benefit from the debt-financed fiscal operation, record in size, begins to wear off. And so what we're seeing now today is real, indisputable. It's not going to persist.
Mm-hmm. Okay. Now, I know you don't analyze the stock market, so I'm not asking that, but do you still look at the broad equities market as a leading indicator of any kind of economic activity, or is that game over? Long gone.
I don't believe it's a good leading economic indicator. It hasn't been for a long time. When economies become highly over-indebted, that pulls down the marginal revenue product of debt. In other words, the amount of GDP created per dollar of debt goes down. And when that happens, the velocity of money declines.
Mm-hmm.
And you have to remember that GDP is money times velocity. So the Fed comes in and they greatly expand the money supply. And people say, aha, didn't Friedman say inflation is always and everywhere a monetary phenomenon? Yes, he did. He most certainly did say that. And here we have the fastest money supply growth since since World War II. And faster inflation is coming. However, if you look at Friedman's great paper, look at his algebra, he bases that statement on the requirement that he believes the velocity of money will be stable. So you come in with a debt finance package, money supply increases.
Right.
But then the velocity of money declines. So when the velocity of money declines, then what happens is the liquidity is trapped in the financial market.
Okay.
That leads to a bidding up of financial asset prices. And it leads to a decline in the return on financial assets. But it does not make its way into the real economy. Mm-hmm. So you have a strong economy, a strong stock market, but it's not a very good economic indicator. But what is a good indicator are your corporate profits measured in the national income and product accounts, after tax and adjusted for inflation. The reason those are great is because they're computed on the same basis for every single period. In other words, there's not 20 addendum items in 2020, in the first quarter of 2021, and then 5 addendum items in 1948, all on the same basis. And also the data come from the Internal Revenue Service. Well, you can misstate your earnings to internal revenue. If you boost it over true earnings, will you pay higher taxes? Mm-hmm. Anyone really do that? You can also understate your earnings to save on your taxes, but you could get into trouble for that, right? Yeah. So who has the best data? The IRS. Well, that's who the national accounts use. And if you look at these profits, they've basically been trendless now since 2012. So the stock market's at an all-time high, but real corporate earnings haven't gone anywhere now for 9 years. Now, I wouldn't question the fact that you've got 2 or 3 dozen firms that are doing extremely well. We all know their names.
Yeah.
But what does that say about the smaller and medium-sized corporations? They're not doing really well. Mm-hmm. And so the fact of the matter is the stock market is a very poor economic indicator. Right? As a fixed income investor, I would not want to be influenced by it. Another argument that you hear is, well, in the stock market, a measure of wealth. Well, it is a measure of wealth, but the wealth is highly concentrated in upper income individuals. And so there's virtually no holdings of stocks of any significance below the top quintile of income earners and wealth. And so even when Robert Shiller of Yale tries to econometrically find this wealth effect of stock prices on consumer spending, it's really not observable. Now, we know it takes place. High-income individuals will buy more luxury goods and so forth. But the impact is just simply not there. I've tried to measure the wealth effect myself numerous times. And I can find something like this. If you get a $100 increase in wealth after 3 years, you may boost consumer spending a cent or a penny or something like that. Very inconsequential. It just doesn't really matter. It's there. It's a legitimate argument, but it's not empirically verifiable. And so the stock market is not a good indicator. What people want is they want a simple single-shot indicator they can see in their screen.
Yeah.
And draw a conclusion from that to the broader economy.
Yeah.
Economy is too complex for that.
Yeah.
Now, there was a time, if you go back far enough, in which the stock market did have some cyclical properties, but I believe they basically lost it.
Okay. Now let me ask a question based on a comment you made. What does when you see flat earnings for a period of 9 years, what does that tell you, Dr. Hunt?
Well, it tells you the same thing that the per capita GDP figures tell you. Real per capita GDP is our basic measure of standard of living. And the reason you do per capita terms is that way you extract the demographic problem, which has not been good because our demographics are deteriorating. They're deteriorating in Europe, Japan, China. And that's the negative for economic growth in itself because it depresses investment. Think of what families have to do to bring babies in, educate them, and so forth. Think of what businesses have to do to provide goods and services for growing families. Think about what state and local governments. We have a negative demographic. So you've got to look at GDP in real per capita terms. From 1871 until 1997, when we became heavily over indebted, the real per capita growth was 2.2% per annum. Since then, it's only been 1.2.
Okay.
Now, you may say, well, that's a relatively small difference, but you compound almost 1% per annum for almost 25 years. Get out your compound table. Makes a big difference. If you had maintained the pre-1997 growth trend after 1997, at the end of last year, your real per capita GDP would have been 60,000, not 56,000. Makes a big difference. And so your growth rate's coming down, corporate profits in real terms are flattening out. We're not doing that well. And there's an additional confirmation of the fact that we're not doing well. Because although demographics are influenced by a whole host of things, including social attitudes, demographics have been demonstrated to be very economically sensitive.
Okay.
In other words, you need certain prosperity. Form families, have babies. And the fact that the demographics in the United States have deteriorated is a confirmation of the fact that the economic circumstances have been not as good. And in Europe, that is more heavily indebted than the United States, their growth rate is worse, their demographics are worse. In Japan, which is more indebted than either the Europe or the United States, population is actually declining, has been. And that compounds the problems. And even now we're beginning to see a very significant deterioration in demographics in China.
That's right.
And when economies do well, they have vibrant demographic factors. The sort of little bit of good news is that the average age in the United States is 38.
Interesting. I didn't know that.
But in China, it's 40.
Okay.
Now, the average age in the United States is inching up. It's not moving up, right, but it's moving up, okay? But the average age in China 2 years from now will be 41. Every 6 months, every 12 months, the average age is going up 6 months because they have a worse birth rate. Remember, they had one child per family. They've got a huge mismatch between young men and young women.
Mm-hmm.
And so if you look at our demographics, we look better compared to Europe. Europe looks better than Japan, and Japan looks better than China. But the fact of the matter is, one of the constraints on global growth is very poor population trends and the whole set of things that you look at in addition to population.
Interesting. It makes absolute sense. It makes me very curious, actually, about certain emerging markets. And I didn't know the average age in the United States was 38. But it makes me curious about certain emerging markets. with healthier balance sheets. I'm not sure if that would be a consequence.
Well, I don't follow the emerging markets.
Yeah.
But if you take the United States, Europe, Japan, and China, plus Canada and Australia, that's more than 80% of global GDP.
Right. Yeah. So, okay. Got it. Okay. Look, Dr. Hunt, I booked you for 30 minutes and I've used them all.
Okay.
I appreciate your time. Thanks so
My
much.
pleasure. Thank you for the great questions.
All right. And I'd love to do it again sometime, but thanks again. I really did appreciate it.
My pleasure. All the best to you.
As always, if you enjoyed this content, please hit subscribe. I'd love to have you on the team. And if you want to take the next step and go a bit deeper with my content, I publish a free weekly newsletter every Friday where I debrief my portfolio. I distill the top lessons I've uncovered from the guests I've had on this show every week. And I talk about sectors and industries that I think are poised to move, areas that I'm looking for opportunity, and places that I'm allocating capital. I love writing it. We publish every Friday. The link is right beneath this video. Love to have you join the tribe.